Hi, everybody, and welcome back to video number 3. Here we were looking at payment of salaries. We're going to debit salaries expense and credit cash. I assume that's pretty familiar with you. And here we have cash for services that have been provided. And again, we have partially received accounts receivable and partial cash for that. So we need to divvy that up between those accounts. Okay. And then the general ledger keeps expanding here for our cash accounts, accounts receivable, and service revenue. And here we've declared and then eventually paid our dividends. So once we've declared it and then we paid it on October 31st, you can see that we have debited dividends and credited cash. Oftentimes there is a delay, however, between when we declare those dividends and then we pay those dividends at some subsequent point in time. Okay, so here is a listing of all those journal entries and what we just posted by in the general journal in page number 1 up here. Oops, page 1 up here. And you can see that it's by the posting reference is the general ledger account number. Okay. Then we're going to post all these to the general ledger. And here it's more of a true depiction of a general ledger in that it has these posting references over here, which reflect the general journal's page number. And then it has an account number here and a running balance here. In red, you see that that's the ending balance for those accounts. That's what's going to come over to the trial balance. And here is the trial balance right on cue. So it's a list of accounts and balances at a given time. It's usually prepared at the end of the accounting period, and it lists all the accounts in the order that they appear on the ledger, with debit balances on the left, credit balances on the right. Of course, debits and credits must agree in total, and it proves the mathematical equality of those debits and credits after posting. And also, we can use it to uncover any errors that you might have in journalizing. If you had a debit entry, let's say in accounts payable, you would know something was amiss because that would normally have a credit balance. So there we go. We got the trial balance for Pioneer Advertising, and it's pretty clear those are going to be those ending balance items from the general ledger. Okay, so you can see these are listed in general ledger account number order. Now it's very easy to see how we're going to get our first financial statement. Here's our service revenue and here's our expenses here. So that's going to be our income statement. And then we're going to do our adjustment to retained earnings, as you will see here. So the trial balance, it does, even though the trial balance might be correct in that it balances debits equal credits, that doesn't necessarily mean that all the entries have been correctly generated and posted. So the trial balance may balance even when we don't record a transaction, when we omit posting a correct journal entry, we post a journal twice, we use incorrect accounts, the most common, and we might make offsetting errors in recording the amount of that transaction. So here are an example of all that. And I won't go through each one of these in the form of debits and credits, but here are all our um, transactions during the month. So they want you to journalize these transactions here, then post them to the ledger, and then prepare a trial balance. So I won't go through the debits and credits. I think you're pretty well on top of that. But they do give you the chart of accounts. So you know what accounts that they're going to be using for this process. Now, you remember there's an income summary, for example. That's an account that we use in our closing entries. So we won't worry about that too much right now. All right, so here we posted and prepared a trial balance. So we have to, first of all, journalize all the transactions, which we've done here. I'll let you look at it a little bit here. Okay. Now, those balances are going to go into the general ledger accounts, as you see here. And you have ending balances for all those accounts. Then those ending balances roll right into the unadjusted trial balance. And there they are. And of course, the debits equal the credits. We'll assume that they've all been correctly done. And now we're going to do our adjusting entries. Here, we want to make sure that all the transactions have been posted, even though they have not maybe been paid in cash. So we're going to report on the balance sheet the appropriate level of liabilities and assets and stockholders' equity, and at the same time, the same thing for the income statement, proper revenues and expenses. And we do these every month for the most part. Adjusting entries are required every time a company prepares financial statements. So we call these kinds of adjusting entries here deferrals. Okay. And deferrals are expenses that are going to be postponed before we find them in the income statement. Here we have our prepaid expenses here, where we paid say for insurance, prepaid rent, or any money that we've received in advance before the services are performed. That's going to be a liability called unearned revenues. And we want to make sure that we post those little beauties as well. We also have accruals. They joke that it's a cruel world, right? In any event, pardon the bad joke there. In any event, we have accrued revenues. And in this case, our accrued revenue are revenues for services that we have performed, but we haven't yet received the cash for that yet. Okay. And then here are accrued expenses. These are expenses that we've incurred, but not yet paid in cash at the end of the month. All right. So the big accrued expense, of course, is wages at the end of the month. That's the one that normally we will do as well. Okay, so there's a couple of things I want you to know about adjusting entries. Adjusting entries never involve cash. Never involve cash, right? So you won't see a debit or a credit to cash when doing an adjusting entry. And there's always at least one balance sheet account and one income statement account. So the prepaid expense there is going, as you see, is going to be a debit to prepaid expenses. Strike that. It's going to be first we're going to have an unadjusted balance in the asset account. And then as we use that prepaid expense, we're going to debit that adjusting entry. The opposite for unearned revenues. All right. So as we earn those revenues, we're going to credit earned revenues and debit unearned revenues. whereas prepaid expenses were a little bit different. Okay, let's look at that. Prepaid expenses, that's assets paid for and recorded before the company uses them. The cash payment before an expense is recorded prepayments. Often involve, as I mentioned, insurance expense, rent expense. Those are the big ones, but we also have some others. Let's look at one for supplies. Supplies we treat as an asset in this course. So Pioneer purchased advertising supplies costing $25,000. So this account is going to show a balance of $25,000 of advertising supplies on the trial balance. Now, what we do is we go out and we inventory how much is left at the end of the month. And at this point, we have $10,000 left at the end of the month. Therefore, we've used $15,000 of those advertising supplies during the month. So what we do is we debit let's try that again. We debit supplies expense here for $15,000, and then we credit supplies, which reduces supplies and increases the expense, which eventually reduces stockholders' equity. And there it is right there. Debit supplies expense, credit supplies, because we've used up those supplies. Okay. And that adjusting entry is shown here in the general ledger as a credit to supplies and a debit to supplies expense. Now, prepaid expenses for insurance. We prepay $6,000 for a 1-year fire insurance policy. So we normally would do that in the prior year, which we did here on October 4th. But in this case, the coverage is going to begin on October 1. So we debited the cost of the premium to prepaid insurance, an asset at that time. So we're going to have a $6,000 balance in prepaid insurance and a credit to cash to pay for it. Now, what we do is after 1 month, we're going to use up 1 month's worth of that prepaid insurance, in which event we are going to debit insurance expense here for $500 and credit prepaid insurance here for $500. And then that shows nicely on the general ledger as an adjusting entry. You can see that prepaid insurance balance has now gone down on the balance sheet. And we've increased our insurance expense, of course, on the income statement. Now, another form of prepaid expenses are depreciation. And this is where we're going to reduce the cost of our asset over its useful life. And we say in a rational and systematic manner. So we're going to estimate that depreciation in this case to be $4,800 a year. It costs $50,000. Its salvage value was $2,000, so that's a depreciable cost of $48,000. We divide that by 10 years. That's going to be 120 months, and that's going to come out to $400 a month. So we divide 48,000 by 120, we get 400 per month. So we're going to look like this. And at the end of the month, we're going to debit depreciation expense on the income statement and credit, you'll remember, accumulated depreciation on the balance sheet, a contra asset. Okay, and there's the effect on the general ledger. This looks like a good place for us to stop our video number 3. And when we return, we will continue on with how we look at depreciation. Until then, bye for now.